Mr. Chairman. And thank you, Chairman Gensler, for appearing before us today. Now, over the course of the last few months, I've had the opportunity to both ask the SEC's Director of the Division of Economic and Risk Analysis and the Director of the Division of Investment Management about the private funds rules. In particular, I've asked about revisiting the economic analysis to ensure that it adequately considered the disparate impact on emerging minority and women-owned asset management firms, minority and women-owned businesses, and historically underinvested communities. Dr. Wachter assured me that the SEC shared my concerns, and Director Birdthistle testified that the economic impact analysis was expanded to look into these concerns. So my question to you is, can you confirm that the economic analysis was expanded, and if so, can you speak to the specific changes that were made in response to the findings from that expanded analysis?
The rule, as other rules do, considers the effect on small businesses, and in this rule particularly, the economic analysis looked at small businesses, including those that are women-owned and minority-owned, investment advisors running private funds.
So I would like to follow up on that, but I got so many questions I want to ask you because it is really important about to get more details of what those findings were. But I'll ask you more about that in writing and get a response, because I want to shift to a related issue that I find to be disturbing. On page 553 of the private funds rules, the Commission seems to seriously suggest that smaller investment advisors, who we know are likely to be predominantly minority and women-owned, consider reducing their assets under management to avoid registering with the SEC to help mitigate the impact of the rule to them. Now, Mr. Chairman, Gensler, we know that minority-owned firms are 3 to 4 times more likely to fund minority enterprises and their portfolio companies. So wouldn't telling these firms to stifle their own growth perpetuate the lack of diverse representation in the industry and therefore decrease the amount of funding going to diverse entrepreneurs?
As the economic analysis noted and you just read, there are often some firms, whether it's in a rule like this or other rules, that are right at a cutoff point, where they might be registered and regulated and not, that they might make different choices. But overall, this rule is actually really helpful because it promotes competition and transparency. The biggest fund managers would have to provide greater transparency to their investors, and the smaller asset managers can actually benefit from that greater transparency and competition around the side letters that they might be cutting with large asset pension funds and the like. So it's really a balancing of these economic considerations. It was pro-capital formation, it was pro-investor because it promotes transparency in the middle of the market, that asset managers would have transparency about their fees, their performance, and these so-called side letters that they enter into.
Well, I just have problems with it because it seems to me, again, you're telling these asset managers to not grow, to continue to build where they can do more because of the people that they serve. So it's an issue for me, but of which I'll follow up on. Under your leadership, the SEC has been, incredibly active, and I'll leave it to others to discuss the pace and the breadth of the Commission's rulemaking. But what I wonder is whether or not the SEC considers how their proposed rules will interact with existing and draft rules during the rulemaking process, particularly when it comes to economic impact of the finalized and pending rules. And do you think there would be any value to doing a whole holistic analysis?
We do. In each economic analysis, which often runs between 100 and 250 pages, each of those considers other rules that may have been adopted and adjusts the baseline in each of those analyses.